Hello, everybody. My name is Carl Frank with A&I Financial Services. Thank you so much for joining us today. Our topic is China Then and Now, a Journey Through the Decades. Our special guest speaker is Louis Lau. Louis is a distant friend of mine, but a friend nonetheless. He's an investment manager with Brandeis. You're going to enjoy everything he has to say. Please hold your questions until the end, or just go ahead and type them in as you think of them into the chat menu on Zoom. In the little bar, the blackish colored bar that appears either at the top or bottom of your screen, usually, is a chat button. And you can ask a question in the chat menu at any point in time. We're going to record this presentation. It will be available on the internet. But to keep everybody private, we're not allowing the video or the voice recordings to take place. Today's conversation is going to be an insightful conversation about the remarkable changes that have taken place in the world and in China in particular. We're going to discuss investment implications and complexities of China's rise and development, and we're going to have the chance to ask the questions here at the end. A little bit about Louis. Louis is the director of the investment groups at Brandeis Investment Partners and is a member of the Emerging Markets Investment Committee. Prior to joining Brandeis, Louis worked at Goldman Sachs in investment banking and equity capital markets. Based primarily in Hong Kong and a fluent Chinese speaker, Louis worked on several large landmark IPOs and mergers and acquisition transactions for China-based companies. Louis earned his MBA in Finance and Accounting from the Wharton School at the University of Pennsylvania and a BBA in Finance from the National University of Singapore. So without further ado, it is my pleasure to introduce Louis. Louis, the floor is yours.
Thank you, Carl. Let me pull up the slides that I have, and then we'll go ahead and get started. Okay, great. I believe everybody can see the screen that has my presentation. So once again, Carl and A&I, thank you so much for having us join and talk to your friends and clients. It's a great pleasure to be here. Today, we're gonna take a journey through the last several decades for China. And China has exhibited a remarkable rise in many different aspects, not just economically, but also geopolitically, as well as their influence in the world, and also the influence in many markets, financial markets and other asset and even commodity markets. So today we're going to review kind of the journey that China has been through, how they were able to achieve the current status, and then try and maybe look into the crystal ball a little bit into the future to see where China might be headed and what opportunities exist for economic development and investment opportunities in China. First, just a comparison of how fast and how dramatically the Chinese economy has grown relative to the US. So in the year 2000, so basically over 20 years ago, the US economy was 8.5 times China's economy. And then by 2010, the US economy was just 2.5 times, still pretty massive compared to the Chinese economy. And then in the last couple of years, the US has been about 40% larger in terms of its economy relative to China. And at the current growth rate, it is estimated that by 2025, the US economy will be just 20% larger. And by 2030, the Chinese economy is expected to be about the same size as the US economy. And how has China been able to do that? The next slide clearly shows that China has been able to maintain a pretty significant GDP growth potential, GDP growth rate, faster than the United States. So while the US was growing between 2 and 4% in most years, China was growing at between 6 and 8%. And in certain years, the growth rates reached above 10%. So by just math, China was able to catch up rapidly in relative size to the US. And in the following slides in the presentation, we're going to talk about kind of the outlook, is this expected to be sustained in the future? But first, we're going to see how China's growth compares with the rest of the world. And here is the same story, which is showing that China has accounted for an increasing proportion of global GDP growth. So relative to the size of the speed at which global GDP has grown, the same story is shown here, where China is able to grow much faster and account for a much larger portion of global GDP growth. We switch quickly to the geopolitical dimension. And here, the US News puts together a power ranking that looks at the size of the country's economy, their military, the influence, both in terms of economics, policy, international alliances. And you can see that China has been ranked the second most powerful country in the world after the United States. And ominously, Russia sits at the third position. But one of the interesting things is that, if you group countries into alliances that are led by the US and the West, and versus alliances that are led by China and Russia, so basically more of the autocratic governments versus governments that are more democratic, you can quickly see that the US-led or the Western-led alliance still has a bigger share of global GDP, and it still has a bigger influence in the world. So later on, we may talk about how the Russia-Ukraine war has somewhat changed the calculus for China. It definitely has much more issues to think about as it confronts some of the geopolitical issues. But one thing to point out is that the US and Western-led alliance is still much more influential than the China and Russia one. A different survey is being used here. The Lowy Institute is an Australian-based think tank that looks at the geopolitical power of Asian countries, and it includes the US, but doesn't include Europe in the analysis. So just kind of excluding the European countries, we can also see that it is consistent with the prior US News survey that China ranks as the second most influential or powerful country after the United States. One of the interesting things is that China, I think because of COVID headwinds and other regulatory interventions by the Chinese government, the geopolitical power has actually declined since 2018. And I think one of the interesting things that the survey points out is that vaccine diplomacy might become the new currency in terms of gaining geopolitical influence. And the other interesting thing is that Southeast Asia has always tried to balance the benefits it gets from economic trade and economic relationship with China, but it's also dependent upon the security, at least military security provided by the US, right? So I think a lot of the Southeast Asian nations, have expressed a desire not to be, being put in a position to choose between the US and China. So a lot of the smaller countries in the world, I think, are in a similar position where they are trying to benefit from the economic relationship with China, but they are dependent upon the security relationship with the US. Moving along, I think this is an area where more and more countries in the world are becoming less and less comfortable, which is as China continues to grow in terms of economic influence and also the need to maintain its alliance with countries that supply commodities, or to develop global alliances, for example, to build infrastructure. So there's been a Belt and Road initiative that's been introduced by China to improve the infrastructure in some of the lower income countries. It often cites some of these interests overseas as a reason for building up its military. And here you can see that China has actually had a very rapid rise in military spending over the last few decades, both in terms of forecasts to 2030, and also historically. And by far, military spending in the US is still expected to be higher than China, but it's growing at a much slower rate. So I think the outlook is for the size of China's military to start to close in on the US in the next decade. And this is creating a lot of anxiety, especially for the smaller countries that may not have the capability to defend themselves. So we go from the GDP growth of China, rapid GDP growth, and the geopolitical influence that China has to the economic outlook. And here we're going to address some of the ways that China has grown the economy, but also what are some of the future challenges that China might face. This chart shows that in order to reach the goal of doubling GDP that China has from 2020 to 2035, the average GDP growth per year that China would have to maintain is between 4 and 5%. And that's necessary to reach the goal of becoming a moderately prosperous country in the next decade or decade and a half. And I think that may have some challenges, as we can see in the next few slides. But before we get to some of the challenges, China still has a huge promise as a large consumer market. So here, is an estimate by UBS, but if you survey most economists, you will reach the same conclusion, which is that by 2030, the size of China's consumer market is going to be almost the same size as the US consumer market. And in the next slide, we also show that in terms of the middle class consumption, China is expected to, by 2030, be the largest middle class consumer market. And here, I think it raises some interesting questions because many multinational companies have gone to China in search of this very large market. And that includes some of the world's largest financial institutions, going to China in search of opportunities for financial penetration, wealth management. Some of the biggest American banks are present in China. So whether it's BlackRock or JP Morgan, HSBC, many of these large financial institutions and consumer products companies have a very big presence in China. And that creates a number of challenges. Number one is, Chinese government is very sensitive to comments on, that are politically, that could be politically sensitive, right? So earlier on, you saw Nike and Adidas get into trouble with some of their remarks on the use of Xinjiang cotton. And so they have to thread this balancing act between kind of Western values, environmental, social governance goals, ESG goals, but also, kind of the Chinese government's sensitivities to some of these issues. So that's a balance that, Western companies have to keep in mind when operating in China. And then when you look upon kind of how the sanctions have taken place in Russia, essentially a lot of Western companies like Shell and BP that have been operating in Russia for a very long period of time, that have billions of dollars of assets, have had to walk away, or at least state the goal of trying to divest some of these Russian assets, as the sanctions took place, right? And so if, China were to be put in the same situation, arguably the economic stake that many US companies have in China will be multiple times as large as what they had in Russia, right? So I think it presents an interesting challenge when trying to exert influence over sanctions on China. Maybe the US may have to go about it in a slightly different way, but I think it raises a lot of questions, and it may put global multinational companies in a very awkward position as they try to capture some of the huge promise of China's consumer and financial markets, but at the same time trying to balance other considerations. The Chinese economy has, in terms of structure, has gone through a remarkable transformation. So when you look at the contribution of GDP by economic sectors, you can see that tertiary industries like services, and that includes financial services, e-commerce, information technology, the contribution to the economy as of 7 years ago, has already gone above 50%. And the secondary industries, the factory of the world that China has been very famous for, the blue line, has actually gone down slightly. And obviously primary industries have actually gone down in importance. And so the Chinese government, through a series of 5-year plans, we're now at the 14th 5-year plan, believe it or not, for the last several decades has been able to steer the Chinese economy through moving up the value chain, through starting a lot of new industries, almost by government mandate, has systematically been able to shape and upgrade the value add, in the Chinese economy. And newer industries that have been a focus of the Chinese government, like solar panels, electric vehicles, smartphones, semiconductors. A lot of these areas, have been promoted by the Chinese government, that then gave a lot of local companies, as well as some foreign companies, being invited to set up facilities in the Chinese market to upgrade the industrial base of China. And that's how they were able to systematically transform the structure of the Chinese economy. Just a case in point, when I started my career in financial services, that was in 1999 when I joined Goldman Sachs in investment banking in Hong Kong. A lot of the industries that were being privatized started off with telecommunications. So very basic, wireless cellular companies that were being brought to the public markets. And then it was followed by some of the IPOs that we had helped bring to market from some of the oil and gas companies. So these are relatively, basic industries. But then it was followed by some of the larger IPOs of Chinese banks. And then now we can see that the decade prior to this, had seen a lot of IPOs and offerings from internet companies, right? So even in my own career, I've seen, the transformation of the economy take place through the capital markets in terms of the types of companies that are coming to market and the types of industries. And that really is kind of the reflection of what's been happening in terms of the structural transformation of the Chinese economy. Now, we'd like to address some of the challenges that China is facing. And as the Chinese economy becomes bigger and some of the factors that have led to its rise begin to peter out, I think China is reaching the point where it's starting to, have to address some of these longer term challenges. And one of the big factors is really demographics. So if you look at China over the last 30 to 40 years, they've been able to grow GDP simply by taking the population from rural areas, and many of them move to urban areas or special economic zones to seek employment in factories and offices, and basically help to urbanize many of China's leading cities. And that, has been dubbed the greatest population migration that, the human race has ever known. So basically the transition of people from rural areas to urban areas, and that automatically gave rise to, GDP growth. In 2015, China saw a decline in the working population for the very first time. And these are, people from 15 years old to 60 years old participating in the labor force has declined for the first time. And so the ability for China to continue to rely on the demographic dividend, I think, is slowing down. And then the other factor is also the rate of urbanization. So China has been able to bring the urbanization rate from a very low level to the current 70% urbanization. And so the remaining gains from that, there will still be some, but nevertheless is meeting a slowing dynamic going forward. one of the things that we look at is just the amount of debt that the economy has relative to the GDP per capita. So relative to the wealth of the citizens, China actually has relatively high debt. So you can see that the non-financial sector debt of China is almost 250 to 300% of GDP, which is close to Europe, is close to the US. Japan is by far still the leader in terms of debt per GDP. But for a relatively low GDP per capita, the other driver that China has been relying on to drive GDP growth has been the use of debt. And we can see that China is now more cautious on growing credit as it realizes that debt can no longer be completely relied upon to drive GDP growth, because some of those some of the increase in debt is leading to financial risk. And where has all the debt gone? I think there's been several areas that the Chinese government is well aware of the risks. One of them has been real estate. So there's been a dramatic curtailing of new debt issued to real estate development companies, right? And we hear statistics about the number of apartments that relative to the number of people in China is pretty high. And so that's an area where an excess supply of apartments may have been created because the GDP growth was driven by a lot of debt going into real estate construction. Infrastructure is another area that may also have been the beneficiary of debt in the past, but is now being curtailed. I think the other area that is not yet an issue, but the Chinese government is trying to clamp down on is really unsecured consumer debt. So basically, a lot of the younger generation taking out online loans for the purpose of consumption. It could be to buy a new phone, go on a vacation. It may be to buy luxury goods, but a lot of that, that's where a lot of the new debt that's been issued by some of the internet companies have been going into. That is a risk for the younger generation in terms of their indebtedness. But one of the things that we can take comfort from is that relative to Western central banks, China has not grown the balance sheet of the central bank by buying their own government securities. So in other words, it hasn't made use of quantitative easing to buy bonds to suppress the interest rate. Whereas Japan, the US, Europe, there's been a huge expansion of the size of the central bank balance sheet where it's buying more and more of their own issued bonds to depress interest rates. So there could potentially still be this lever that can be used by the People's Bank of China, if they wanted to suppress interest rates further. That's something that a tool that they could use that they haven't used before. So there's still substantial room in the central bank balance sheet to stimulate the economy if China wishes to go down this path. So that's the good news. The bad news is the debt is already pretty high for the GDP per capita. What is the solution then for growing GDP going forward for China? One of the things that China has realized early on is the use of R&D to not only upgrade the industrial base, but also to find new ways to innovate. And here we show that R&D spending has been increasing rapidly in China, almost rivaling the US. And I think in the US, I think we have a issue with science and technology education, and also the continued development of primary research that can be used for technological applications in the US. I think the US is still by far the global leader in terms of innovation, but China has caught on to this and is spending billions of dollars in R&D to further their innovation level. We talked about some of the 5-year plans, and that now China is on to the 14th 5-year plan for the next 5 years till 2025. I think one of the the things that is not lost upon the Chinese government is they know that the old ways of growing GDP are no longer going to work as well in terms of increasing debt. The demographic dividend is slowing. Real estate construction, infrastructure, that has to be used by a very measured fashion. And going forward, the focus is going to be on growth, but with a quality angle to it. And innovation is a very big part of the current 5-year plan. And here, we have already mentioned some of those areas where China is going to focus on, but just to kind of make it a little bit more complete, you have a focus on manufacturing, upgrading, new emerging industries that could be strategic to the economy, and then further developing the digital economy, digitalization. One of the weak points that China is facing is that it is importing about 60 to 70% of the semiconductors that it's been using as it manufactures electronics and electronic goods. And that's a gap that they would like to close over time. So semiconductors is also another area that China wants to be self-sufficient. And I think talking about self-sufficiency, that's a mantra that the Chinese government sticks very closely by, as it can see that perhaps markets like the US and other markets may be more hostile to Chinese imports. It wants to develop the domestic demand as a big source of demand for some of the goods. And so sometimes you might hear a term called dual circulation, which is basically the circulating of the production and the consumption and the demand to be generated internally within China. And so thereby increasing self-sufficiency and reducing the risk of being reliant on external demand for a lot of China's exports. So I think a lot of the weaknesses of the Chinese economy is not lost on the government. You can see that through the 5-year plan, they are trying to address some of these weaknesses. Now we turn our attention to regulation. And one of the points that has been more of a contrast or maybe even a stark contrast in the last few months, ever since Russia invaded Ukraine, is just how differently the economies are run between an autocratic economy and a democratic economy. And when we look at the regulation that has been quite severe and quite intense in China in the last 2 years, the basic root of why that regulation was necessary is really inequality. So when you look at China, for the level of development and the relative wealth of China, compared to a lot of the developed countries, the social inequality and the economic inequality is actually very high in China. Here, with the Gini coefficient, we show that China actually has one of the largest rates of inequality in the world. And I think when we look at the data, 15 out of 20 of China's billionaires made their money through the technology industry. And this was also aided by a lot of foreign capital that was flowing into the technology industry. So when we look at the crackdowns that have taken place in some of the major internet companies, it has its root, in inequality within China, but also some of the foreign capital that has gone into China, in search of returns, that's been driving the growth and success for some of the internet companies. So in order to smoothen out some of the fruits of the success, China has embarked on a relentless drive to regulate some of these internet industries. And some of it is justified. There were breaches of privacy, there were breaches of security by some of these internet companies, there were monopolistic behavior. So some of it, definitely needed to be corrected. But one of the main reasons why this has taken place is really the inequality and the monopoly status of some of the Chinese internet companies that has made the Chinese government very uncomfortable. We already talked about this, which is the wealth concentration of the top 10 in China at 65 to 70%. It's actually one of the higher. Is actually at the higher spectrum, when we look at the overall range of countries. This is a chart that shows, the year where GDP per capita reached 20% of the US for the first time. And I think this is also raising the question of whether China can escape the middle income trap. And you can see that some of the countries like Japan, the blue line, Korea, the light blue line, and Taiwan, the green line, after they reached 20% of US GDP per capita, they continued to grow and close that gap with the US. China is starting at a very low level. They obviously haven't reached the levels that the North Asian neighbors have been. And I think one of the big challenges for China would be to continue to increase GDP per capita, to eliminate poverty. That's definitely a stated goal of the Chinese government to do so. They have been very successful so far with the autocratic system. But I would just also note that Japan, Taiwan, Korea, those are democratic countries. They've been able to do that with a mix of democracy and certainly some state-led initiatives to develop the economy. And I think it will be curious to see if China can replicate the success of some of the North Asian neighbors. We talked a little bit about regulation in China, and here we just list a few areas where China has targeted for for more regulation. So education in terms of after-school tutoring, technology. Recently, you may have seen Didi, which is basically the Uber of China, been asked to relist at home. So there's definitely been a focus on asking companies that have sensitive information and sensitive technology to relist in the home markets. That has also been an issue. But I think China lately has realized that delisting all of the ADRs from US markets is going to be an extremely costly as well as disruptive event. So it started to take on a more conciliatory stance of trying to work with the SEC and the PCAOB, Public Accounting Standards Board, in the US to try to reach a compromise to keep the ADRs listed in the US, right? So I think it realizes that it cannot escape basically the dollar-based trading system in the world. This is sort of getting away from regulation, but just kind of touching upon China being in such a position of having such large foreign reserves and also being dependent upon the US dollar trading system is going to make it very difficult for China to completely decouple from the US. Even if it wants to do that for political reasons or national security reasons, I think it's slowly realizing that it's not going to be able to do so to the fullest extent. What are some of the things that we're seeing with China as investment managers? So here we turn our attention to the development of the financial markets, which has been kind of a mirror image of what's been happening in the economic sphere and what's been happening with GDP growth. Is that at the inception of the emerging market asset class, Malaysia was the biggest market, followed by Brazil, and Mexico, and some of these are heavily dominated by commodities and oil production. And if you fast forward till today, 30 years from then, you'll see that China is now the largest market in emerging markets, and it really mirrors the size of the growth, and the growth of their economy is also reflected in the emerging market equity class. And that is not the end of the story, by the way. You may have heard about the A-share markets in China, and these are companies that are listed in the Shanghai and the Shenzhen stock exchange within China. So this is different from foreign listings in Hong Kong or the US. And this chart basically shows that at the current point in time, only 20% of the A-share market has been included in emerging market indices. The MSCI has stated that it has a plan to include more of these China A shares into its indices. And so the conclusion may be that China could go from 30% of the emerging market index to over 40%. So if MSCI's plan, goes according to what they have envisioned, China can become a larger part of capital markets. But as you may have seen, there's a lot of political opposition within the US for MSCI to do that. But there's also been questions about the full accessibility of the A-share market. A lot of the financial disclosure is published primarily in Chinese for the A-share market. And so it's not an easy market for foreigners to get into. And so by including more and more A-shares, it may make it more difficult for especially managers that are based outside of the US to access the Chinese market. So that's something that I would say is has been sort of halted for the time being. There has been no further increase in the inclusion factor for A-shares in the foreseeable future for now, just because of some of these reasons. But that issue might come up later on. And finally, maybe a word on the how attractive we think China's market has been in the past. So this is a chart showing the price to earnings ratio and the discount to premium that the China index has relative to the emerging markets index. And this is a common valuation ratio that most managers, at least one of them, the major ratios that they will look at. And one of the things that I would like to point out is that in 2016, a lot of the Chinese internet companies were included in the index for the very first time. So you saw a little bit of a bump in valuation in starting from 2016, but with all the concerns about the GDP growth slowdown, the continuation of the zero COVID policy, continued COVID outbreaks, the valuation of the Chinese market has actually derated quite a bit in the last couple of years. And so here, we noticed that it's trading at 11 times price earnings ratio, which is in line with the historical average. But actually, as at the end of March, that ratio has dropped further to 10.3 times. So we think that, from a historical standpoint and from an absolute standpoint, the Chinese market looks attractive. But one of the interesting things that you may or may not realize is that for some of these markets that are very dominated by government policy and autocratic governments, is that the market responds much more to policy changes rather than solely economic changes. So what I mean by that is every 3 to 5 years, when China goes through a phase of economic growth acceleration followed by a slowdown, there have been episodes where regulation and government intervention has taken a bigger role. And the markets are often looking for signals from the government that this regulatory phase or the GDP growth phase, GDP slowdown phase is coming to an end and a new growth cycle is about to occur. So we're currently at this point in time with the Chinese market, which is the market is now looking at policy for directions on where the Chinese economy or the equity market may be headed. And it's somewhat of an alien concept, for those of us who are used to dealing with the US market or free markets where, free enterprise is allowed to dictate how markets move. It's, the pace of how Chinese markets move may be quite different from global markets. So I'd like to stop there and conclude that when we look into the long term, we think that there's plenty of opportunities, especially with the new 5-year plan and the guidance that's been given by the Chinese government to continue growing its GDP, to continue developing economically. There's a number of geopolitical issues that China will have to tackle, including how it deals with Taiwan, as well as how they can position themselves in the light of the US becoming more proactive in terms of sanctions. But we think that it makes sense to have some exposure and have some familiarity with the world's second largest economy, the second largest market. There can be tremendous opportunities for investing, no doubt with some wild rides here and there. That's a feature of the command and control economy, but over the long term, it remains a core market for emerging market and global investors. And with that, I'd like to conclude and turn it over to for Carl for any questions.
Louis, thank you so much. That was great. I got a million questions, and I can't wait to get the Q&A started. So I hope folks in the audience go ahead and type into the chat menu. Again, that's at either the bottom or the top of your Zoom screen, and you'll be able to ask a question there. We do have one that popped in there, and I've got 5 or 6 others that I'm sure are on top of people's minds. But let's start with the one that we have, because it's right directly related to what you just most recently talked about, and that's regulation. And Liz, how do you and maybe your company, or any investment manager for that point, because maybe limited about what you can say about the future for what you're thinking, but how do you account for government interference when you're looking at the valuation of these Chinese companies? I mean, I'm just going to leave it there. That's a complicated situation.
Yeah, it's a good question, and it's one that we grapple with all the time. I think there's maybe 3 angles how I would answer that question. I think the first angle is to really determine the ownership structure of the company. So is it a company that's state-owned, or is it a company that's privately owned? And if it's state-owned, is this a company that will likely benefit from government policy in a sense that there's some companies that maybe in the technology field, in the semiconductor field, or telecom companies developing 5G networks that could be national champions that the government is supporting, and so will have favorable government policy towards? Or is this a company that is basically going to hoard cash and not use it for productive purposes? And we see a lot of state-owned companies doing that. And if so, those type of companies, those type of state-owned companies would deserve a lower valuation multiple. It may be 1 or 2 turns below, what we would give a private company, or even more, depending on how it's managed. I think the other feature of the state-owned enterprises is that they may get into certain areas that the government is telling them to get into that may not be consistent with their core business. So over time, one of the reasons why we're more skeptical on, for the most part in state-owned enterprises, is that the business can change quite significantly. So in the past, I mean, this was many years ago, we invested in a Chinese manufacturer of cotton products. But then this company decided that it needed to secure its own electricity supply. And so it went ahead and invested in some electric utilities, right? And so that's a very different business to what we had originally invested in. So that's a risk that we have to be cognizant of. Now, if you thought that private companies were the solution, that's not the complete solution either, because in general, we would value private companies with a higher valuation because most of the founders are families that are very astute businessmen that are starting companies in China for the purpose of profit, and they're usually the majority shareholder. And so they are usually looking for very good economic returns. And the internet companies are good examples of this, and we have other private companies as well. But I think one of the issues that has emerged is whether these private companies are doing things that would be in line with central government policy, right? So I think that's another risk that we have to factor in. That will be the second dimension. So recently, we were looking into some infant formula milk companies in China, and we realized that one of them had very high prices for very difficult to justify nutritional value. And so that wasn't really in line with common prosperity, or some of the premiums being charged, I think we felt were inappropriate. So we've avoided that particular company. So those are some examples of how even in private companies, we try to be cognizant of that. And then the third dimension would basically be capital allocation policies, how a company decides to allocate capital to new projects. I think that's very important to the ongoing returns. And the other, dimension that we try to control for is really allocation to these companies. So if that's a company where there's likely to be, more government intervention, then we'll have a smaller allocation to that. And then a newer risk factor is really not just, government intervention could be also from the US government, right? So we've seen the Trump administration put China Mobile, China Telecom, Sino, a lot of companies on the list of companies that US managers can't own, right? So we've seen increasing examples of this where governments are dictating what companies can or cannot be owned by managers. And so we have to assess the sanction risk for certain types of Chinese companies. And so that is another thing to consider. So needless to say, the conclusion is our job has become more complicated, but there's a number, quite a wide variety of investment opportunities that we can still take part in China. And so these are some of the things that we have to take into account.
That's great. Thank you for that. And I love getting kind of the inside baseball about how you're making your investment decisions in a really complicated world. How do you view, just a follow-up related to that, how do you view markets in a whole as handling autocracies versus democracies? I mean, in the wake of what happened in Ukraine, are things changing?
Yeah, things have definitely changed. And we don't know if this is going to be short-term or long-term. And what I mean by that is in the short term, we've seen an increasing risk premium being embedded into Chinese equities. And it's really hard to tell where that risk premium comes from exactly, because it comes from, I would say, a few things. One is the ambiguity that the Chinese government has, the attitude towards Russia. They haven't come out openly to condemn or at least dismiss what Russia has done as being unethical, but rather it's sitting in a very ambiguous position of trying to maintain that friendship and relationship with Russia, preserving that capability to import cheap raw materials from Russia, but at the same time it doesn't want to be caught up in US secondary sanctions. It doesn't want to be disconnected from the US dollar trading regime. So none of the Chinese companies or publicly listed banks have been helping, helping Russia to evade sanctions. So it's coming from that, but at the same time, it could also be coming from, the COVID outbreaks, the continuation of the, zero COVID policy. It could also be coming from a, economic slowdown in China. So I think markets, I would say, are trying to price in to some degree the autocratic nature of governments, and this may even precede the Russia and Ukraine crisis, because in the internet regulation and the regulation of internet companies and other industries in China, we have seen the Chinese government is capable of closing down an entire industry overnight, and that was after school tutoring, right? Because it was seen as increasing the anxiety and inequality among students and parents. So I think that kind of a regulatory risk premium has been embedded in Chinese equities, and I think the Chinese government has made better signals in the last few months, saying that there will be more predictable regulation. But the lack of due process, as we have in the US, that's not present in China, I think that contributes to a discount. And most of the autocratic markets, I would say, trade at a discount to democratic markets. I think I can say that in general in the capital market. So when we conduct valuations, we shouldn't have any illusions that these valuations are going to go back to reflect a political system of free enterprise that supports free enterprise that doesn't exist in these markets. So we have to be realistic in how we value these companies to determine if they're cheap or expensive.
That's a really good advice, I think, to think that just because it's cheap doesn't mean it's a bargain. What do you think about, I get some really great questions on the screen. I think you might have incidentally asked or answered one of them about the forward price earnings and some of the reasons why there's a disconnect more recently. I have a feeling has something to do with what you just answered here. So let me answer a couple of the others. And one I hadn't thought of, so let me just dive right in there. And, ESG, environmentally, socially, government, really climate change is a huge part of Western culture. And it may not be that way in the Soviet Union or in Russia or in China or any of the autocracies. So what is happening in China? How does that affect investing in China? And if those align or don't align with the West, what does that mean for those of us living here?
Yeah, no, that's a great question. You will find that, as with any kind of argument, coming from a different country, China's take on ESG could be very different. So I think one of the things that I realized that was interesting when I, take part in conference calls is that if you're doing something that the Chinese government is encouraging, that is seen as good governance within China. So basically, the G is not really looked upon entirely as good governance for shareholders. But when I heard some domestic managers talk about that, the G, the governance angle, may be more looked favorably upon if a company is investing or developing their strategy in line with government policy. So that's a slightly different take on G. In terms of social, that usually crosses into the political realm. So, I think there's been a very hot debate about, forced labor in Xinjiang, or the use of cotton in Xinjiang. I mean, it's just an example. I mean, it could be other issues of, social issues as well. But, that's an issue where Western companies have taken a very different approach, saying that, they will not use any cotton from these areas, and the domestic companies have kept silent. So interestingly, you may have seen in the last couple of weeks, basically a sovereign wealth fund in Norway was divesting in one of the sportswear companies in China because that company has not made adequate disclosure of where the cotton is coming from. So you see this clash of values, if you will, between a sovereign wealth fund, in a Nordic country versus a Chinese company, and so that can actually be positive because following the divestment, the Chinese company actually came out and put forth more disclosure and tried to communicate with the capital markets their position on some of these raw materials and the sources and kind of the efforts that they were going through, right? So I think that social aspect, can lead to clashes. And so that might be, very interesting to observe as the clash of values takes place within China. One of the good things is that on the E side, environmental side, I think China, and this is coming from Xi Jinping, has been wanting to be on par with the US in terms of championing environmental goals and cleaning up the environment. I would say that some of the goals to be carbon neutral by 2050 or 2060, they are not really as ambitious as one might have hoped. I think one might have hoped that the deadline would be brought a little closer, a few decades closer. And I think one would have hoped that maybe some of the standards being imposed were stricter. So it's not, I think it's a little bit below what most of us are expecting that's coming from China. Is a good first step. But I think that they still, and this goes for India too, that a lot of these developing countries are still putting economic development as a pretty important priority when setting environmental goals. But that being said, I mean, China has made huge strides. I mean, it's established an exchange for trading carbon credits. The A-share market is looking at rules to mandate ESG disclosure in financial reports and more ESG reporting among A-share companies. So China has definitely taken positive steps. And here, I think that's where the goals of the US and China are aligned in terms of, pushing companies to increase environmental standards.
Fascinating. That's an interesting conversation there, I think, about ESG is not universal in different parts of the world will view it in very different ways and what their priorities are. Okay, at least one more big question. I know it's on the backs of the minds of a lot of different people. And again, when we put this presentation together, Louis, you and I, when we talked about it January, February, it was before February 24th and Russia's invasion of Ukraine. And almost immediately, many people's attentions went to China's intentions with Taiwan. And, China has a one China policy. It wasn't very long ago that China absorbed Hong Kong, which had been politically independent for a very long time. So what does that mean here in the future? How do we view this? If you follow any sort of news, it depends on where your news source is, how likely this is to be a military conflict, or is it not at all that way? A different news source might say that the Chinese government is all about stability, and they would never make that decision. So I think it's just interesting to get different perspectives. I know none of us know the future, particularly this year. I think we're all humbled in the wake of what happened on February 24th and what's still happening in Eastern Europe. But what is your perspective on the China-Taiwan problem, and particularly in one of Taiwan's most important industries for the world? There's a question here about Taiwan semiconductors. So if you have any perspective on, and maybe not the company as much as their expertise in that island, can you help us understand, get us a perspective on Taiwan?
Yeah, Carl, I think that's a big topic, and it's come up in almost every call that I've had with clients since February 24th, understandably. Also because Taiwan is actually the second largest market in emerging markets after China. So if anything happens to Taiwan, the market investability and the value, that will also have a significant impact on that as well. So it's a very important question. I think it's also a very complex one. So here are a few things to think about. I think the difference I see between China and Russia is that I think China has made a lot of efforts towards being a global leader, trying to exert its influence and trying to build, kind of the group of alliances in the world. Sometimes in opposition to the US, not necessarily, all the priorities are aligned with the US, but I think it's spent a lot of effort trying to do that. And so I think by taking Taiwan by force would just detract from that goal, right? And having seen what the US and Western governments can do in terms of economic sanctions to Russia, I think that would undo the many decades of Chinese economic progress that we saw in the slide. So I think the Chinese government is pragmatic. I think they're not solely focused on military goals, unlike Russia. I think Russia is ready to put everything on the table in order to, achieve its goals in Ukraine. China is not like that. I think the government has broader priorities and more importantly, economic priorities. The other consideration is one of practicality, because when you look at the Chinese foreign reserves at $4 trillion or $5 trillion, they do have to put a substantial portion of those central bank reserves in US and Western assets, because if they don't, then it would be very difficult to maintain the stability of the Chinese yuan. So it wouldn't want the yuan to rise, that would compromise the ability to export. And so it's too big to have an entire balance be put in gold or other commodities or other instruments, because a lot of these markets are a lot smaller than the foreign reserves that China has. So I think by economic necessity, it's going to be very difficult for the People's Bank of China to really change the reserve composition. So I think that's another practical consideration. The other consideration that China has is that this is from China's perspective, is not necessarily what people might believe in, but the Chinese perspective is that China is only getting stronger economically, militarily, and we don't know when that time will come. Is it 10 years? Is it 15 years? I think it believes that it will be in a position where it can easily take over Taiwan in the future without much opposition, or it becomes so attractive for Taiwan to join China by the nature of economic might, right, that China would have. Of course, that basically puts aside the, democracy and the values that Taiwan has built up, politically over decades, right? It's basically a democracy that's going to be very difficult to come under the communist or socialist fold. But China believes time is on their side. They don't necessarily have to engage with Taiwan militarily in the near term. And so they hope for a day to come where it will become much easier for Taiwan to join them. And so I don't think that an invasion is imminent. I think what Russia has gone through with Ukraine and the sanctions, it serves to teach China that it's probably not in a position and is not ready to take on the challenge of taking Taiwan by force, at least not at this time. The other thing is that Taiwan is a very important supplier of semiconductors and is an important part of the hardware supply chain. So anytime that supply is being disrupted, there's going to be huge economic implications for basically the entire world, right? And basically, I think Beijing will be put at a very difficult position if it were to disrupt that supply. We already saw what the disruption of supply and sanctions on Russia can do to the oil and gas markets globally. Imagine what will happen to the IT hardware market if the Taiwanese supply chain were to be disrupted, right? So, I mean, that would be an economic calamity of a different scale that I don't think China would want to, open that can of worms, at least not now. So, and I think the other interesting thing I've heard about, when I talk to my friends on the mainland is when Taiwan joins China, it doesn't necessarily mean that Taiwanese companies' value will fall to zero. Rather, it may be more like the status of Hong Kong, where Hong Kong companies are allowed to exist, they're allowed to operate, they integrate with the mainland, and it doesn't automatically mean that TSMC's value will go to zero. It may mean that maybe there is some kind of a discount because now they are part of a Chinese territory. Again, I'm not making any predictions. I'm just saying that it's not an automatic conclusion that the value of Taiwanese companies will be eroded just because they're being integrated with the mainland. I think that's another interesting point that not a lot of us are kind of appreciative of.
Thank you so much for that great perspective. We have just come on to over an hour, and I have a million questions still, and would love to continue the conversation. I'm sure that there are many people listening who would like to do that too. What I encourage everybody to do, we're going to record this. It's going to be on the website, hopefully as early as next week. Please send us emails and reach out to us, and then we will get some questions from Louis. I'm going to go ahead and bring us to a close, if that's okay with you, Louis. Any closing thoughts from you before we wrap it up?
Yeah, no, thanks, Carl, for this tremendous opportunity. I've enjoyed this presentation, and we remain open for any follow-up or any questions. So thank you so much.
You are so welcome. Again, send them to your advisor or to me, and I will forward them to Louis, and we'll continue our conversation. It's a pleasure to work for you all. It's a great honor to have Louis come in and do this. Not a lot of investment managers make the time to talk to real-life people like you and I. And so, Louis, we greatly thank you for making the time for us today and for putting together this great presentation. We've got another one coming up next month. We've got inflation is a hot topic. Again, we put this together before we hit 40-year highs in inflation, as we've done very recently. So if you're interested, please join us next month on May 19th. I will have a fixed income manager join us, and so I think you may enjoy that. And then really importantly, in the real life financial planning that we do, this one is near and dear to my heart, Compassion and Choices. Kim Kalinin is one of our country's leading experts on how to make end-of-life decisions with compassion and care for yourself and to make it easy for the people you love. And this is going to be a great financial planning conversation. That's a recording that I'm going to want everybody to have, and we've got some great resources for you there too. So completely different topic. We're going to skip June, go off to July, and give us the second half of the year. Now, if you have any questions, here's how you can reach us. Again, My name is Carl Frank, Lewis from A&I Financial, Lewis Lau from Brandy. So we really appreciate you joining us today, and create a beautiful day.